G'day and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us. Let's take a look at what happened overnight. In fact, global equity markets rising to round out the last trading day of the second quarter. European shares registering their biggest quarterly rise in more than 5 years, while Japan's Nikkei, well, we saw that yesterday, recording its best quarter on record. Now on Wall Street, the major indices also notching up their biggest quarterly gains in years. The S&P 500 up 15%, the Nasdaq rising more than 21%, the best performance since 2020. The Dow 13% higher. Now those gains driven by investor optimism about the economic outlook and earnings growth despite uncertainty about the Middle East conflict. However, weakness in tech shares over the past month saw the S&P 500 and Nasdaq register losses for June. And AI-driven demand for data center chips and hyperscale capital spending has seen the Philadelphia Chip Index nearly double since the beginning of the year, led by Micron up 300%, Intel up more than 250%, a similar margin by Marvel. Now, stocks specifically overnight, Nike reported better than expected quarterly results, shares slipping around 6% in extended trade on a cautious outlook. Shares of Constellation Brands, the maker of Corona beer, rose after the bell as its first quarter profit beat estimates. In the travel sector, Wells Fargo hiked the price targets of US airlines, citing easing costs and tighter capacity. However, the price targets on Expedia and Booking.com were cut due to ongoing economic uncertainty and the expected impact of the Middle East conflict on travel demand through to the end of the year. Well, Iran has said that it would not meet with top US envoys who flew to the region following an outbreak of hostilities, dimming the prospects of a lasting peace between the two countries. Jared Kushner and envoy Steve Witkoff arriving in Doha for what the White House described as high-level talks. Meanwhile, Iranian officials have insisted that the regime will maintain control of the Strait of Hormuz, along with US ally Oman, saying they would impose tolls in mid-August when the 60-day period expires. On the data front in the US, consumer confidence rose slightly, while job openings in May rose marginally against expectations of a broader decline. The US two-year Treasury yield up to 4.14%, the 10-year was up to 4.43%. Australian three-year government bond yield futures rising to 4.38%, the 10-year at 4.78%. US dollar index down around 0.1%, the Aussie trading at 69.2 US cents. Oil prices little changed overnight, but have registered their biggest monthly and quarterly losses since the COVID pandemic, with the market pricing in an end to the Middle East conflict. Brent futures, they were down slightly to close at $73 a barrel. Gold edged higher, but has seen its deepest quarterly decline in 13 years, as inflation concerns stemming from the Middle East reinforce expectations that interest rates will rise. Spot gold currently at around $4,007 an ounce. Copper futures rose 1.5%. Iron ore little changed at $100 a tonne, and Bitcoin tumbling around 3%, trading at around $58,500 US dollars. Well, let's now get across what we're seeing on global markets. So we caught up earlier with Peter Cardillo from Spartan Capital.
Good quarter, and even though Nasdaq, did have a substantial correction, Nasdaq did finish the first half of the year with strong gains, and so it's all predicated on the fact that global growth should continue. And I must confess that the markets held up extremely well during the war. From time to time, we did see some sort of a pullback, but in general, the market basically ignored it. And I think the reason for that is that investors were focusing on the post-war factor that would lower oil prices substantially eventually, and that would mean stronger growth on a global scale.
All right, so, and we look in particular at tech. Look, it did come off over the course of the June, but nonetheless, that AI-driven demand essentially for data center chips, hyperscaler capital spending, the Philadelphia Chip Index nearly doubling since the beginning of the year.
Absolutely. CAPEX, very good question, by the way. CAPEX has been very strong. We saw that in the final revision of the first quarter GDP numbers. And we're now beginning to see even a mood shift better, an improving shift for consumers, and that's impressive. So, that even now that oil prices have come down, although gas prices have not come down as rapidly as crude prices have come down. Eventually, they will, obviously, but yet we're seeing this shift, and that's a good positive sign, setting us up for a nice summer rally.
Peter, you mentioned energy, oil prices, their biggest monthly and quarterly losses since the COVID pandemic. Do you feel perhaps the market's getting ahead of itself? Because, of course, we still have no definitive resolution in the Middle East.
Well, the market might be getting ahead of itself, not so much for the war factor, but the fact that, yields are stubbornly high. And this is, I think, the biggest question and the biggest threat out there. Not so much the war, but the fact that the bond market has a very bearish sentiment to it. That's primarily due to the fact that Walsh's tone at his first FMOC meeting was extremely hawkish, and so we're not seeing those yields come down just yet. Now, again, if we see a resolution to this war, which I expect that there will be some sort of a resolution, because President Trump needs to end this war and needs to end it rather quickly. He has a political problem at home, and he needs to save the midterms, in spite of what he may or may not say. And so I think even if there's no peace deal within the next 5 or 10 or 15 days, the talks might just continue to drag on. And with the ample supplies of oil out there, oil prices should move lower. Now, of course, there is a concern, and that is that stockpiles are at very low levels, and that could be an offset to oil prices moving, let's say, down to maybe $50 or $55 based on the supply and demand factor. So there are some caveats out there, but I think by and large, corporate America is not going to disappoint with Q2 earnings, and that should sustain the present valuations.
What of those lingering inflationary effects out of the war in the Middle East, Peter? How do you see that affecting, I guess, what you're seeing in the US economy, interest rates, and corporate earnings?
Well, it's amazing. Even though we'll start with the consumer, even though consumers are paying higher prices, and prices have gone up pretty much across the board. It's just not in oil prices, not in energy, and yet they're coping with it. We look at consumer spending; it's not extremely robust, but it hasn't fallen off a cliff. We look at retail sales, and that's the same story there. In terms of inflation in general, it's stubbornly high, and because of that, we've seen the yield factor rise over the past 2 months, and yet that's still not really shown any weakening of the consumer, both in spending and in purchasing and sentiment. In fact, if you looked at the consumer data, the consumer's confidence data that came out, we did see a rise, and not much of a rise, but the previous month we saw a big jump, and that was all predicated on the fact that peace talks are underway, and the market is pricing in a some sort of a deal.
And Peter, inflation, interest rate expectations weighing on gold. In fact, what it's had its deepest quarterly decline in some 13 years. What are you seeing the outlook for the precious metal?
Well, right now it's obviously in a bearish market. There's a bearish sentiment there. It had a terrific year in the first 2 months of the year, and last year had a terrific year. And it's all due to the higher cost of money. But if we should see a reversal and we should see yields come down, I will stick to my prediction that by year end, we could probably see gold get close to its record highs and maybe even higher. It's all about the cost of money. It's certainly not reflecting a crisis in the foreign exchange markets. I'm referring to the dollar yen spread. So any reversal in the bond market, I think you'll see people flocking back into gold.
That is Peter Cardillo from Spartan Capital. Now let's focus on where we're likely to begin this Wednesday. The start to the new financial year. Positive start, only marginally up around 8 points. We'll get across that in just a moment. Join us for the open.